Go over the 2024 IRS tax brackets and other important tax information that the Internal Revenue Service has recently put out. So let's take a look to see what they're talking about. First, we should discuss a little bit about how and why the IRS publishes tax brackets and other things like that. So each year, the Internal Revenue Service releases inflation adjustments for dozens of different tax provisions by issuing what's known as a revenue procedure. So revenue procedures don't only cover tax provisions, they cover a wide variety of IRS administrative decisions. But this is the revenue procedure method is how they publish tax bracket changes, things like changes in the standard deduction amount, marginal tax rates, certain tax credits, tax exemptions, and exclusions. So for 2024, that was published on November 9th through Revenue Procedure 2023-34, where they released over 60 different updates. So we are going to go over the key changes, specifically standard deduction, marginal tax rates, certain tax credits that were updated in this revenue procedure, as well as tax exemptions and exclusions. We're not going to cover all 60 different updates. We're going to hit the highlights. So changes in the standard deduction. So for this little chart kind of breaks down the different tax filing statuses: married filing jointly, married filing separately, single, and head of household. So as you can see, married filing separately, they're exactly the same as single taxpayers, and they have roughly 50% of the deduction. So a single taxpayer in 2024 has $14,600 as a standard deduction, which is an increase of $750 from 2023. Conversely, married filing jointly, a couple has $29,200, which is an increase of $1,500 from the 2023. And married couples filing separate returns are in the same status as single. And then head of household is it's kind of in the middle. So head of household basically is someone that has one or more qualifying children as dependents. If you are a widow or a widower, you can be considered a qualifying widow or a widower with a qualifying child as well. So that standard deduction is $21,900, which is an increase of $20,800. So for taxpayers who are wondering whether or not they should itemize tax deductions on Schedule A, basically this is the new hurdle that you have to jump over. So in other words, if your itemized deductions for 2024 end up being less than $29,200, then you might be better off taking the standard deduction. And each year that it increases means that the standard deduction becomes a little bit more preferable, all things remaining the same compared to itemized deductions. So when you're itemizing your deductions, you should take a look at opportunities to do things like perhaps bunch charitable contributions so that you're not spreading out charitable contributions over years. You might take the standard deduction in 1 year, and then you might lump 2 years worth of itemized deductions into one tax year, get a bigger bang for the buck, and then still take advantage of the standard deduction every other tax year. So we'll put a little bit more guidance on that in the notes. We'll link out to our instructions on Schedule A. So tax bracket changes. So the tax brackets themselves have not changed. However, the income limits for each tax bracket have increased, basically due to inflation. So we're going to go through, we'll just outline that tax brackets for all tax filing statuses range from 10% all the way to 37%, which is the highest end. So 10% tax bracket for single taxpayers is $11,600 or less than that, which is an increase of $600 from 2023. Forgive the typo. Then the 12% tax bracket is anything more than $11,600, and that is also an increase of $600 from the previous tax year. The 22% tax bracket, that income limit is $47,150, up $2,425 from 2023. The 24% tax bracket is $100,525, which is an increase of $5,150. The 32% tax bracket has a new income limit of $191,950, which is up $98.50 from 2023. The 35% tax bracket, single taxpayers may earn as much as $243,725, and that's an increase of $12,475. So the 37% tax bracket applies to anyone making greater than $609,350, and that's an increase of $31,225 from 2023. So we're going to go to the married filing jointly tax brackets. You'll see that most of those tax brackets, basically the increase is almost exactly twice as much as the single, with one notable exception. So 10% tax bracket, married filing jointly is $23,200. That is the increase of $1,200. Every other increase, $48.50 for the 22% tax bracket. The 24% tax bracket is up $10,300 from $197.50 to $201.50. 32% tax bracket is $383,900, an increase of $19,700. The only one where there is what used to be considered a marriage penalty is at the highest tax rate. So at the 37% tax bracket, it is not exactly twice as much as the single taxpayers. It's slightly more at $37,450 as an increase. So if you look at that, you can see that each of these income limits is twice as much for married filing jointly, except for the 37% tax bracket, where you would expect that twice as much would be somewhere north of $1.2 million, and it's clearly not. It's only at $731,000. So there is a marriage penalty that still applies at the highest tax rate. Tax credits. So there are two notable tax credits that I saw in the revenue procedure that came out. First, it was the adoption tax credit, which can be claimed on IRS Form 8839, and the new maximum credit allowed for adoption-related expenses is $16,810, and that's an increase from 2023, where it was at $15,950. The other big one is the earned income credit, which taxpayers can claim on Schedule EIC if they meet certain income criteria. So you can claim the earned income credit for anywhere between 0 and up to 3 or more qualifying children. Once you get past 3, you don't get additional credits. So the maximum allowed is $7,830. That's up from $7,430 in 2023. So this is a refundable tax credit, which means you can actually, if you qualify, you can claim a certain amount of this credit, even if you're even if you did not pay any tax, you can still get a refund. For 2 children, the maximum credit is $69.60, which is up from $66.04. For 1 qualifying child, $4,213, which is up from $39.95. And if you have 0 children, you you can be eligible if you meet the income criteria for up to $632, which is up from $600 last year. And finally, the notable exclusion and exemption limit increases. So the big one was the alternative minimum tax, which is calculated on IRS Form 6251. So the way it works is everyone technically is subject to either the normal tax liability or an alternative minimum tax. But for the vast majority of taxpayers, you get an exemption based on how much your tax liability is. So that exemption for 2024 for single taxpayers is $85,700, and that's up from $81,300. So, if you calculated your AMT and you had $100,000, you would be able to claim an exemption of up to $85,700, and you would be responsible for the balance. There is a phase out that begins at certain income limits, and that phase out limit has increased from $578,150 to $609,350 for single taxpayers. For taxpayers, married taxpayers filing a joint return, that AMT limit is 133, or the AMT exemption is $133,300, an increase from $126,500, and the phase out now begins at $1,218,700 as opposed to $1,156,300. There's an increase in the foreign earned income exclusion, which taxpayers would calculate on IRS Form 2555. That new exclusion is $126,500, which is an increase from $120,000. The annual gift tax exclusion is the amount that you can give to any single person without having to calculate a gift or estate tax liability. So in the United States, the gift and the estate taxes are coordinated. So if you have, say, $20 million, you may be subject to estate tax provisions after you pass away, or your estate would be. If you try to give away some of that money before you pass away, if you give away too much at any one point, you still have to calculate it and report it to the IRS. You might not have to necessarily pay tax right then and there, but you do have to keep track of the total assets that you've given to any single person. So what a lot of people might do is give away smaller chunks of money to a wide variety of people. And the typical example would be grandparents that have enough money to be concerned about the estate tax, and they want to protect their estate from tax as much as possible, because the estate tax can be 40% of whatever the amount is above and beyond the exclusion. So what a lot of people might do is they'll just give away little chunks of money every year, and these chunks do not need to be reported as long as they're under the gift tax exclusion threshold. That threshold has increased from $17,000 to $18,000 per person. So if you have 10 grandchildren and you're trying to wind down your estate to protect it from estate tax, you can now give away $180,000. If you're a married couple, each spouse can do that, and none of that has to be reported to the IRS. So that gift tax exclusion does help people wind down their estate if that is a concern of theirs. Overall, the estate tax exclusion has increased from 12,920,000 to 13,610,000. So that means that if your estate is below that, and for the vast majority of Americans, this has never been an issue, and it probably will never be an issue, but there is an increased exclusion of roughly $700,000. So that's all we have for this video, this update. Please stay tuned. We'll put out videos as the IRS promulgates new guidance on the upcoming tax year. And if you want to be able to download this PowerPoint slide for quick reference, please click the link in the show notes, and we'll take you to a page where you can access this form and download it for your own use. If you have any questions or comments, please post them in the comments section. And thank you very much, and have a great day.